What are we doing, Joe?
We're doing the year-end review 2024, Jay.
You ready?
I'm ready. Let's do
All
it.
right, Joe, in 3, 2, 1, action.
It's the end of 2024. You know what that means, a year in review. We'll be looking over what happened this past year, what didn't happen this past year, things that were shared, things that weren't shared. And from that, it'll provide insights for 2025 and beyond. I'm Joe Mullings. From 160 Studios 2024, a year in review. '24, what a year it's been. And I would like to think that this is going to be a Peeran moment for MedTech at large as we slide into 2025. As I review 2024, it's going to provide all the insights we need into where the market's going in the next few years. And when I say Peeran moment, here's what I think. When I look at the MedTech industry, the machine that drives innovation, taking care of our patients, healthcare at large, is the emerging tech and the startup world. And forever, that world has revolved around venture capital. And we have seen over the last few years that venture capital cannot be the only solution we have. So by Peeran, I mean that we can no longer revolve around those entities. And luckily, what we've had declare itself over the last year to two are a number of other vehicles that are going to be incredibly important for us to remain successful and put the right solutions into and in front of the patients. So here we are. So we've got the PE VC-ish mentality. What do I mean by that? We've got the build to buy model and the buy to build model. The build to buy model reflects entities like Orchestra Biomed, like Revival Healthcare. That's where we will identify gaps in the large strategics portfolios and then partner with them in an off-balance sheet opportunity, develop those technologies. The startups or the emerging tech companies no longer have to worry, will I have an acquirer as I develop this product? Will I need to put together a sales team? What can I sell it for? It's going to become a tighter market, but you're going to have more robust and more meaningful technologies come into play. And then the buy to build model that you see with Ajax Health is an example. Again, another PE VC-ish construct. But that is where you look at a product or a company out in the market, like a Cordis in Ajax situation, where it was a somewhat distressed product platform company that is a chassis, as Duke calls it. And in that chassis, you've got the infrastructure of a commercial team, although it needs to be top graded. You've got the infrastructure of an existing pathway to market, albeit not ideal and in fact distressed. You come in, you take that shell, that chassis, and now you start looking at technologies that are accretive to that model. And you can start to ingest those, invest in those technologies, and push them into that entity. That entity then has an exit, likely downrange. An exit to a strategic, because the strategics are no longer driving innovation. And that accretiveness allows you to have iterative development to drive smaller margins and massive development, disruptive development that you tuck in. And you either take that company public or it gets acquired by a strategic. Without the risk of extinction, you don't have evolution. And the VC model, as it stood to date, has part of it is going to become extinct because it does not have aligned interests with the marketplace. You cannot have a startup wanting to go out and struggle to get a $10 million round, a $30 million round, follow up with a $50 million round, and expect that leadership team to focus on getting the technology out to the marketplace. A time always comes and goes on the construct of what should be in place in order to drive innovation. And I think we're at that precipice, that moment in time, that VC's not going away, but it's no longer the center of universe in innovation in medtech. So as we look at these financing models that are going to support this Peeran moment, that is only one component of it. But let's look at financing models. We've discussed the Orchestra Biomeds, the Revivals, the Ajax, They represent where we need to expand out the, let's call it the dry powder for these entrepreneurs, these innovators, and even the emerging tech companies that have been around for a couple of years and now are running out of gas, running out of fuel, and have had to carve back their ability to get a product to market because there wasn't a buyer in place. The PE, let's look at PE at large. We're looking at a $600 billion a year market in medtech. And PE is no longer not paying attention to that. So you have Bain raised a $3 billion round. You've got Duke with a $1 billion plus round with KKR and other partners like Hologic. So these PE organizations are starting to see that they don't have to take on the regulatory risk of the Class 3 devices, but they can put a structured deal together where you can allow those geniuses and those people who know how to navigate that clinical risk, take that clinical risk off the table, put a structured deal in place, and create a bridge then for that entity on the build to buy or the buy to build. And keep in mind, they're different. Put an entity in place that allows that to be an on-ramp. Will returns be 5, 6, 7x? No. And I think we have to stop expecting that. But if we could have a higher level of confidence, reduce a tremendous amount of risk, give a playing field for those entrepreneurs to remain active in, that 2, 3, 4x risk mitigation, or even equity up into the larger buy to build play makes a lot of sense for the industry at large. And it also opens up public markets. It also opens up the strategic on having a place to go to find innovation, because it's no longer the path forward in a strategic to drive innovation. So let's talk about the market movers, the strategics. I can't address all of them in this short version of my insights on 2024 and where we're going in 2025. But let's look at what they're experiencing right now. Most of these market movers, the inputs on the economic side have become so severe, whether it's supply chain issues, whether it's diminished demand in the APAC region, in particular in China, where a lot of the large strategics made enormous bets, and now there's a bit of reckoning going on there. Whether it's the cost of salaries and payroll for these organizations, the margins are getting tighter and tighter, and the innovation, therefore, is suffering inside of those organizations. So those market movers have to look externally for partners, and they no longer can be a monopoly-minded single, it was not developed here, in order for us to move forward. And let's unpack that a little bit and see where that growth has been. As we look at these strategics, our top players is Medtronic at $32.5 billion, J&J MedTech, $30 billion, Siemens at $23 billion, Stryker at $20 billion. So let me just pause there, and those are the ones I want to unpack a little bit. As we look at those organizations, here's something else to put alongside that. The largest market cap in medtech right now is an $8 billion a year firm, Intuitive Surgical, with a market cap of $192 billion. In 2019, that was a $70 billion market cap. 5 years later, $192 billion. If I look at Boston Sci, 2019, a $63 billion market cap. This year, $132 billion. Stryker, $75 billion in 2019, $143 billion this year. Here's where it gets interesting. Medtronic, in 2019, $104 billion market cap. 2024, $105 billion market cap. No movement at best. Edwards, on the wrong side of the equation as well. $49 billion market cap in 2019. 2024, $43 billion market cap. Here's the big kahuna of them all. Although it's hard to split out market cap on J&J MedTech and where they sit today. But if you go up to their parent company and you decide what gets redlined and what doesn't, here's an interesting trend that isn't necessarily positive for the medical device market at large, even though I do like what J&J is doing right now. In 2019, they were a $384 billion market cap. 2024, they're a $353 billion market cap. In 2023, they were a $431 billion market cap. In 2022, a $461 billion market cap. The trend is not a positive one. And if you don't think that's going to leak down into the medtech industry, I'm not sure where you're doing your math. But here's what it will do. And this is what we're seeing with J&J in particular. It's forcing J&J to finally focus and not try and be everything to everybody. What J&J is doing right now on their cardiovascular side, I think is a very positive sign for the market. And you're going to get a lot of pull-through on that. A couple years ago, the Abiomed acquisition. This year, the Shockwave and V-Wave acquisition. Right? I'm projecting right now, right here, the SpectraWave acquisition that's going to enhance the Shockwave acquisition. I like the focus on multi-billion-dollar markets. I like the focus on being big and first and having a bit of a head start in the marketplace. That makes sense in their cardiovascular portfolio they're growing. They're also starting to shed some of their technologies that aren't serving them well, which is a good idea. But here's where it's going to be interesting to watch as we come out of 2024 and into 2025. What are they going to do realistically with their soft tissue surgical robotic marketplace? Because those bets have been massive. And the return on those investments are still questionable and up in the air. Because if they're going to play that thesis of we want to have a 5-year head start, we want to be able to scale out our large organization, we want to have a very differentiating product portfolio in that area, none of that maps to the strategy that they're playing in the cardiovascular market. So as that market cap for J&J at large shrinks, there's going to be some redlining across the board in that portfolio. Then let's look at Medtronic. That organization has suffered dramatically over the last few years, no matter how you want to make that observation. It was good to hear Jeff say our top priority is restoring our earnings power, full stop. I'm glad that Jeff is focusing on the things, potentially, that are going to stop the bleeding in that organization. But historically, Medtronic has had a mantra of cutting back to profitability, shedding the things that are costing us. What I'm not seeing is investing in the R&D programs that are step changes and what's going to keep that the once great organization. 2025 is likely going to have J&J take the top spot as the leading medtech player because they're only behind now $32.4 billion versus $30.4 billion. I think they're going to make that up in 2025 and move on beyond them. And I'm hoping Medtronic is going to stop its slide. But it's really struggling right now with most of its programs that it's made very large bets on. And we move on to Stryker. I picked Stryker because Stryker has had an excellent ride over the last few years. I do think, though, that their Mako platform and some of their other robotics and their implant business may start to come into risk, be at risk in 2025. You're seeing them make some moves in regards to next gen in that area. I think spinal across the board and large joint ortho across the board are going to have threats come onto the market that you can no longer, one, only drive a screw into the spine as an added value. There are Gen 2 technologies coming out right now from people that are not even clearly on the radar screen that are going to put that market at risk. And then the large joint ortho robotics. That's been fueled by tying the number of implants to the economic model of getting the robot. And if you think that that model of making sure that enough of those implants are bought in order to justify the giveaway of the robot, not literally, but not figuratively, but literally, you're going to have a lot of pissed off customers. You're going to have people saying, wait a minute, if I didn't do enough implants and I promised those number of implants, now you're going to have a back charge on me on this system, or you're going to price it differently. And as these ambulatory surgical centers continue to propagate into the market, And these other robotic systems that are now coming out, especially from Europe, that no longer require you to have a number of implants in order to have a robotic solution or a digital solution, 2025 is likely going to be a year of shifting for companies like both Stryker as well as J&J on the surgical robotic large joint business. And then you can look for Stryker to highly likely need to make an acquisition in the soft tissue robotic world. We've had this conversation over the last year. This is going to be a vintage year that if you don't take out one of these organizations, whether it be a virtual incision, whether it be a distal motion, whether it be a Moon Surgical, even a CMR, dare I say, you're going to be left without, as soon as that music stops, there's not a chair left, you're going to have a problem in that soft tissue market. And the same goes for J&J. I don't think Ottava is going to be their answer because it's going to be way too long and it doesn't play to the thesis of J&J on that soft tissue side because it's going to be quite a few years before Ottava has a chance of getting any traction in the market. They're no longer a soft tissue surgical robotic company, and you're going to run into issues with Moon, distal motion, and potentially even CMR having a head start. Okay, FDA. This is, thank goodness they're friendly and becoming friendlier. And this is really the gatekeeper. Between FDA and CMS, who decide what gets reimbursed, and FDA decides what gets to go on the market, I think that we're seeing FDA become a much more collaborative player, especially in certain ends of the market, and we'll go into that in the soft tissue as well as interventional robotics marketplace. CMS, there still needs to be some work done on that. Brian Johnson, by the way, is doing a very, very interesting study on that coming out of Mass Medic that I won't go into here, but you may want to go check that out, where we're finally unpacking the reimbursement gateway, because you can't get a device funded if you can't answer the first question out of the investor, tell me about reimbursement. All right, so let's look at FDA so far to date. FDA had a phenomenal partnership year with the device world. And look, they're not there to be an empowering partner. Their role is to stand diligently, safety, efficacy in regards to a device as it enters a patient. That can't be compromised. But they certainly could be more collaborative, which is what they've moved to, in being a great partner with the device world. And I believe this is correct. In the FDA's partnership, the last 12 months have had the FDA have 3,325 510Ks, which is a record for them in that 12-month period. They also have had a record number of PMAs pushed forward. Now, some of that might have been to the backlog coming out of COVID, for sure. But anybody who's been in some of these more complex devices, and again, I'll talk about specifically the newer emerging tech because it's highly predictable on structural heart, renal denervation, peripheral vascular, what that playing field looks like and what the playbook looks like. But on the soft tissue robotic side and soon to be endovascular robotic side, the FDA has really stepped in, and we've seen this with a number of the clearances in the last 3 months of 2024. Da Vinci 5 a little earlier than that, virtual incision, Momentus, CMR, distal motion, Moon Surgical, and Procept and Ascensus also receiving additional clearances. That tells me that the FDA has got their process, their system in place, clear line of communication to the OEMs and the startups, and this is how you navigate. We're not going to make it easier for you, we're going to make it more clear for you. And we still have in the FDA, SS Innovation, J&J, and Medtronic and their soft tissue platforms. But now, the elephant in the room. I've been chatting about this category for a few years now, and it still doesn't get enough attention. It's starting to get attention because people can't understand how to unpack it. And that's the changing centers of care, in particular the ASCs. So that's an entirely different animal, the ASCs. Just to give you some numbers. The U.S. ambulatory surgical center market is projected to reach around $55.75 billion by 2033 and $41.3 billion as of today. That's a CAGR of 3% per year from 2024 to 2033. But what's more important than the CAGR are the changes that are occurring in that marketplace, in the human capital, and how product is going to flow through it. Now, the challenge here, though, is some, not most, I want to be fair, some of the organizations are trying to take the same playbook of selling into a hospital, of selling into an ASC. You can't do that, obviously. The reimbursement's different, the case acuity is different, the ownership is different, and guess what? The employees are tremendously different. The mindset of the employees are different. What's also different in there is the workflow and the items that are getting tracked in regards to driving efficiencies. And if you're putting together a commercial organization or a commercial launch, and you don't understand those are all of your stakeholders versus the single or double stakeholders in a hospital, you're going to suffer badly. Your commercial teams are going to suffer badly. And the emerging tech companies are getting a little bit of a head start as they move this CapEx model of theirs into the ASCs, which is a head start on the larger strategics. So let's look at that for a second. And the number one thing is understanding the mindset of the ASC employee. ASCs are going to have a challenge coming out of the gate. Even though the de novos are coming up pretty aggressively, ortho's been at it for a while, cardiac cath labs, OBGYN, neuro, ENT, aesthetics. What they have learned is you cannot take the classic employee out of a hospital and plug that employee into the ASC. They're different mindsets. It's sort of trying to take, again, I'm making a generalization here, trying to take a large strategic employee who's been there for 15 or 20 years and plugging them into an emerging tech A-round startup where what is monitored and what is required and the DNA of the person and the collaborative mindset of a person in a foxhole is different than a highly structured SOP environment of a mid-cap or large strategic. And so what's going to happen in the ASC world is we're going to run into a stutter step because the ASC owners, who are the docs and the PE firms, historically will try and take the same hiring playbook that are used in a hospital in the doc side or in a corporation coming from the PE side and not understand the psychographic, the motivations, or how to market specifically to the ideal ASC employee. Because the decisions in life, work balance, the reward system, the team, the pit crew team around you in an ASC, and the doing more with less, and the embracement of innovation, technology, and the digital footprint moving forward are going to be all the difference in the world. Because retention on the manpower, the person power in the ASC is going to immediately trickle down to how do you articulate your product solution to the market. On the OEM side, if you think you're going to be able to sell a product and leave it at the doorstep on this technology, you already found out in the hospital that doesn't work. Partnering is going to be even more important in the ASC because that's a subscription model straight up. If you sell me this product on a per click or a SaaS or a subscription model and you're not making sure I'm having the best outcome experience and my patient's not having the best outcome experience possible, you're going to be punished. And that is going to be the, let's call it the Achilles heel over the next 24 months in the organizations that don't structure their organizations to address that need and demand in this ASC model. 2024 was a fabulous year, certainly coming off of 2023 and 2022, which we're all glad are in the rearview mirror. But those who learned their lessons from those years, looked at 2024 as that transition year, and understand the Copernican 2025 model we're moving into, will thrive in 2025. It's always important to learn and see the trends. Look at things in an unorthodox way. Challenge that's not serving you. Should I still be doing that? And if I should I be doing it the same way? And what can I take away from instead of adding to what I'm doing in the marketplace? Whether it's product development, clinical, regulatory, go-to-market, commercial, or finance. Those who start to examine what they're doing moving into 2025 and not being shy about it, burning off the dead wood, and adding space for new methodologies, new philosophies, and new points of execution are going to have golden years of medtech ahead of them. I'm Joe Mullings from 160 Studios. Be well.